Good morning, everyone. Thank you so much to the Sustainable Business Summit team for including me today. As the voice of God mentioned, my name is Eric Kane. I'm the Director of ESG Research for Bloomberg Intelligence. And today I want to talk about some recent research that we've introduced that looks at how ESG events drive stock prices and credit spreads. So that'll be the bulk of the conversation. I do want to provide a brief introduction to Bloomberg Intelligence, or BI as we call it, talk about some of the other research that we've done historically to answer this pivotal question about how ultimately we link ESG to financial performance. Then we'll really spend most of the time on the market-moving news research that we've introduced, and then finish with some next steps and some key conclusions, I think. So for those who may be less familiar with Bloomberg Intelligence, or again, BI as we call it, we're one of 3 research arms here within Bloomberg. We have about 500 analysts globally covering over 2,000 companies from a variety of perspectives. So equity, credit, policy, litigation, and of course, ESG, where I come. So when we think about the ESG team within Bloomberg Intelligence, our focus is really, really strict on financial materiality, right? So it's our understanding, of course, that there are a number of issues that are financially immaterial to different industries, and it's our mandate to ultimately help our clients understand what these issues are, how they're impacting businesses, how they're impacting industries. So on this slide, we have a variety of different kind of research and data areas that we focus on, including a lot, of course, on climate and transition, including BI carbon forecasts, where we look at the most carbon-intensive companies, about 500 of them, forecast their emissions out to the years 2030, compared to a temperature-aligned benchmark, et cetera. And just skipping down, we've also worked very closely with our partners across the organization to help build Bloomberg's ESG scores and gender equality scores as well. So for the bulk of the presentation, some key takeaways. I think traditionally when we think about answering this question about the link between ESG and financial performance, the focus has historically been on backtests, right? Looking at a specific metric or looking at a score and using that to ultimately look back in time and see how that corresponds to key financial metrics, whether it be total returns, drawdown risk, et cetera. And that is absolutely key. And we continue to produce examples of that research, and I'll actually go through a couple in a minute. But I think in this moment where this question about the link between ESG and value is even more prominent now than ever, we need to introduce new pieces to the puzzle, ultimately, right? And that's where our market-moving news app comes in, where we really answer a critical component of the question, which is, it's one thing to understand how backwards-looking data may correspond to performance, but what happens when an ESG event is going to take place, be it an oil spill or a product recall? How does this actually impact stock price? How does this impact credit spreads? And that's really the bulk of the work that we're doing on the market-moving news research. And what we'll ultimately see is these responses vary. They're just not always intuitive, so it varies not only by asset class, but also by region. So I mentioned kind of the traditional backtest work that we do. I want to go through just a couple examples quickly. Climate Alpha is one of them. So the idea behind this research is really to look at carbon-intensive industries like oil and gas, steel, cement, airlines, et cetera, to understand what the key climate metric there is in terms of efficiency, and then to see if that ultimately yields an alpha signal or not, right? So on this slide, the example we're looking at is oil and gas producers. We're looking at a global peer set here, and we're essentially looking at top performers on methane efficiency. So those companies that ultimately produce oil and gas more methane efficiently, we're comparing those to the peers who produce it less efficiently. And what we see across the board is that the top 25% in terms of methane efficiency are ultimately outperforming the laggards, the bottom 25%, by about 29% over the last year, and about 13% annually over the last 5 years, and that's total returns. Right, so a very strong signal for those of us who follow this space. We know, of course, that methane is one of the biggest concerns when it comes to addressing climate, right? So if we can think about how ultimately that could be integrated into an investment portfolio, there's tremendous impact for value creation, but also for addressing the emissions associated with your portfolio. Another key backtest that we look at is our ESG alpha, and this really uses the ESG scores that we've been to ultimately look back in time, all the way back to 2017, to understand where across all the industries that we've scored, over 106 industries, where there's a very distinct correlation between performance on an ESG score or a sub-issue and things like total returns or lower drawdown risks. And on this slide, we have a couple key examples, but the examples are numerous across different industries. But here we're looking at health and safety in materials. So materials, of course, includes industries like chemicals, metals and mining, et cetera. And what we see here is that companies that do better on health and safety metrics outperform those who don't. We look at a top half versus bottom half by about 4%, just under 4% annually for chemicals, and over 4% annually for metals and mining, right? So again, a very clear indication that there's a link between performance on an ESG metric, which is of course financially material to chemicals and mining, and outperformance, which we articulate here. So that's a little bit of kind of the history. Now we move into the more recent research that we've introduced to help kind of add another piece to the puzzle. And this is our market moving news research. So what we did here is we decided to leverage the myriad of tools that we of course have here at Bloomberg, and we looked back at 9 years of news data. We used news codes, which are embedded in every story, to identify when ESG events happen, right? So this is an industry-specific lens, so we'll go into it in a minute, but if we're looking at oil and gas, we're looking for events that are specific to that industry, things like oil spills, things like labor strikes, things like fatalities, right? We're looking to identify those issues. We're scrubbing the data. We're making sure we're not looking at duplicates. We're only looking at stories that are high confidence. And then we're also looking to see whether there's a correlation between that event and subsequent changes in either stock price or credit spread. And we'll go through a couple of examples of each. For stock returns specifically, we're looking at 1 day after the event. We're looking at 7 days after the event. And of course, it's crucial to ultimately compare to different benchmarks because we don't want to accidentally account for some other thing that may have moved the market significantly that day. So when it comes to stock prices, we're ultimately looking at a global benchmark, a regional benchmark, and then an industry-specific benchmark. Credit is a little bit different, where our universe is defined by those who ultimately have, at the time of the event, a dollar-denominated bond that is a 5-year bond between, so basically looking at maturities of 4 to 6 years. And then instead of comparing to a benchmark, we're looking at that relative to the government curve. So let's get into some of the results here. So on this slide, pardon the silly title, this is one of my favorite parts of my job, is coming up with cheesy little titles like this. So drilling deeper into oil and gas, pun intended for sure. What we see here is ultimately the frequency of events and the average impact on stock price. So what we see is events like strikes, pay disputes, ultimately occurred most frequently during this time period, and oil spills was the second most frequent. And we also see for both types of events, on average, these contributed to negative impacts on stock price. So just to put some numbers around that, when we look at spills, for example, over a 7-day period, companies that had those spills ultimately saw their stock price or total returns go down by about 1.09% versus a global benchmark, and just under 1% versus a regional benchmark. Strikes, similar result, where we saw about 0.9% decrease over the 7 days and compared to the global, and about 0.74% compared to the regional. And I think one of the great things about this data set is there's so many different variables that we can ultimately look at, right? Here we just see what that dispersion looks like against the various benchmarks, but we can also understand things like, well, what if we wanted to understand whether the stock price responded more to a reputational event or an operational event, right? And we actually see some interesting signals there as well. So as you might guess, Reputational events tended to have a more immediate impact on stock price, whereas operational events tended to have a more lasting impact. So when we shift our attention to credit spreads, another interesting result, and here we see, of course, the frequency of events is a little bit limited because our universe is limited based on the parameters that I set before. But ultimately what we see here is the credit markets don't necessarily respond as robustly to ESG events. And sometimes we actually see a reaction that is not entirely intuitive. So overall, again, we saw a high frequency of strikes and pay disputes. Those actually, on average, led to spreads widening, whereas oil spills, on average, led to spreads tightening, which is, I think, a surprise result. We can then distill this again, this idea of pulling out, a variety of insights. We looked at operational versus reputational before. Here we're looking at how different regions might ultimately respond, right? So we've broken the events down by region, by type, and also by company. And ultimately what we see here is that YPF, for example, in Latin America, had one of the biggest impacts on their credit spreads, 13.04 basis points, in response to a labor issue, right? So even though we may see, on average, the reactions to strikes not being that profound across the industry, maybe this sends a signal that investors in Latin America or investors in YPF specifically have a concern about this one topic. So just to provide another example, another industry to look at this analysis through, packaged food, another example of a cheesy title on packaging packaged food. So here we're looking at stock price again, and again, the frequency of events and the average impact on stock price. So the most frequent event is product recalls, probably not a surprise. And on average, we see some impact on stock price. Ultimately, the issue that kind of met the threshold of having both a high occurrence and also an interesting kind of impact was strikes and pay disputes. But going back to product recalls, which we'll get into a little bit more, we ultimately see that product recalls led to about a 0.2% decrease versus the regional benchmark over that 7-day period, and a 0.3% versus the global. So again, here we see the regional dispersion, and I think there's some interesting things to pull out. Mandated recalls, when we look at that relative to the industry benchmark, actually created a bump in returns, which is, I think, an interesting one to kind of think about why that might occur. And then, again, going to the credit spreads analysis, so similar results in terms of the frequency, but here we actually see product recalls leading to being essentially the only event type in the industry that leads to credit spread widening. And again, this idea of being able to take this data set and really dig deeper and think about other additional insights, we wanted to understand, okay, we understand that recalls are important, the only type of event that on average produced spread widening. Is there perhaps a difference between the type of recall, right? So then we looked further, we saw for mandated recalls versus voluntary recalls, there is a significant difference. So certainly those that are mandated, as the slide here articulates, had a much bigger impact on credit spreads. So I went through a couple different industries that are the two industries that we've done this analysis for to date. Thinking about next steps, we're planning to roll this out for an additional 28 industries, basically to bring total coverage to 30 industries. I think then we're going to surface this as a key kind of data set on our dashboard on the Bloomberg terminal, BI space ESG Go. And then I think the other piece of the puzzle that we'll look to fill in is, okay, we understand these events can have significant impacts on credit spreads, stock price. What might we look at to predict whether an event like that would happen? So we've done some preliminary research in this area. It's called our predictive ESG work. And we looked, for example, at total process safety events and seeing whether that could be an indicator of higher chance of oil spill in the following year. And in fact, that relationship actually did bear out. So we're going to continue to produce additional research to that end. So just to summarize, I think it's pretty clear that this type of research provides yet another piece of the puzzle in trying to answer this ever important question about the link between ESG and financial performance. I think when we look at the ultimate results, it's also quite clear that not all events yield the market response that we might have predicted, which is certainly important to understand. And then even within that, you need to understand the industry-specific events and also how different investors ultimately respond, whether it's credit versus investor, and also region by region. And with that, I'd like to conclude, and I'll leave up on the slide here some QR codes for our weekly podcast. Thank you very much.